Good afternoon, or if you're joining me on a recording, I'm so glad to be with you today at the Cash is Clear Live. Whether you're watching on YouTube, you're watching on Facebook, or you are watching on LinkedIn, it doesn't really matter because I'm going to have a lot of great information for you today. Because did you know that there's a simple process to help any company improve cash flow? I'll tell you what it is right now. Number one, you model the cash flow with a predictive cash flow model. Number two, you manage the money coming in and going out of the company. Number three, you mentor the people within the company, whether it's the business owner. If you're a business owner, you got to learn at least the basics, but also the people supporting the business owner. And it's not just finance, it's all over the place. So mentors, number three. Number four, you maximize cash flow and profitability. Now, there's a fifth step that's the glue that holds this all together, but you're going to have to wait because I'm going to be telling you what that is. And that is the key to being able to manage cash flow for any company. So stay tuned. But for right now, I want to give a special thanks to our sponsor, Pivot 2026. And you can see right here, there is a link that I've put up. Right there, pivot2026.com. It is the Unconventional Cash Flow Conference. What is it? It's a 4-day boot camp using a hands-on case study to learn about cash flow optimization, maximization, and cash maximization as well, cash flow and profit. They're not the same thing. And that's one of the things you'll learn over time as you follow me is what's the difference between cash flow and profit. So it'll be a small group environment. We're going to have a maximum of 20 people. I say we because I'm the lead instructor, and it will be all personalized. It's not going to be a massive group, and we're not paying speakers to speak about whatever their product is. This is there for you to learn and come away from it in just 4 days, really having a significant base of knowledge to go out and help every company that you find or your own company. So mark it on your calendars, May 24th through 29th, and go to Pivot 2026. So what are we talking about today? I've already gone over the highlight. Let me go into some more depth on each one of the steps: model, manage, mentor, and maximize. Let's start with model. Now, I want to make sure everybody understands exactly what I'm talking about and I want to tell you first what I'm not talking about. And I'm going to do it by way of illustration with a client. I was working with the client and they needed a bank loan. Okay, I'll be glad to help you. Yes, I can help prepare a cash flow forecast. That is what the bank asks for. When I do a bank, well, I'm not going to tell you what I do normally. I'm going to tell you what exactly the bank asks for. They ask for a P&L projection, a profit and loss projection, accrual basis, which means the theoretical sales that happen when you get a contract and you complete work and you invoice. When you invoice is when you, from an accounting perspective, you show that a sale is made. And then you take the terms of the invoice and apply that for when the cash is coming in. And it's the same thing with expenses. You take all the theoretical expenses and you apply it as if cash was coming in on those dates, cash was going out on those dates. And so that's what the bank asked for. So that's what we provided. Now stick around because I'm going to tell you what happened at the end when the bank gave the client a loan. But let me first tell you what I gave the bank initially was a cash flow forecast. That's what they asked for. So what's a predictive cash flow model? It is trying to mimic reality, saying this is reality as we see it, we think is going to happen. This is the prediction, and it's based on past performance. So did we predict revenue? Absolutely, positively. We predicted not the accounting revenue, but we predicted cash deposits into the bank account. Now, this particular client, they had receivable issues. They invoiced for 30 days, but the structure of their business, their clients were always second guessing on the invoices, verifying all sorts of issues. They had to get paid from their client before they could pay my client. It was a mess. So reality is they were paid anywhere from 45 to 60 days out, not in the 30 days. Do you think that makes a difference? Absolutely, it does. So that's number one. And that, more than anything else, was different than the theoretical. But what is the major impact? The major impact is you've got to pay wages. You've got to pay material suppliers. You have all these expenses that are coming in, and you're getting paid not in 30 days or less. You're getting paid 45 days or more, but you've got these bills coming due. So the more you grow, the more labor there is, the more it sucks up your cash, and the worse it gets. So my cash flow model, which we sent to the bank, and I did this through the CFO. The CFO had other strengths. They were an operational CFO, not a financial CFO. So I was coaching the CFO. I sent it to the CFO. The CFO was part of developing it, and they sent it off the bank, and the bank rejected it. They rejected the cash flow forecast. And so I said, well, what do they want? And what it came back is they wanted that P&L. And it was very specifically not a cash basis, but an accrual basis P&L. So we created it. It's a lot easier to do one of those, let me tell you. It's a lot easier. And we sent it. The loan was approved. Well, if they had taken a close look at the cash flow forecast that we provided first, no reasonable person who understands business at all would have given this company a loan. So what happened? 2 months after they got the credit line, they had used every single penny of it. And it was supposed to last them a year or more, and they were back in the same trouble. And that is exactly what the cash flow model predicted, because we were trying to predict reality. So you're building a predictive cash flow model based on the movement of money in and out of the company, so you can predict the future accurately. And what do you predict? You're trying to predict, is money going in or coming out of the bank account? Do we eventually start putting money in the bank account? Do we have credit lines we can pull from and then put back? If we put a capital infusion in, add $50,000, for example, does that solve our problem long term? Or does it just get us a month or two down the road, which is what happened to my client? The infusion of capital didn't really help them long term. No, it didn't help them at all long term. So that's what you're trying to predict. And depending on the type of business you have and what your financial situation is, you might be trying to predict what's happening tomorrow because you don't have enough money in the bank to really not pay attention day to day to day. Or you might be able to go a week or 2 weeks or a month between, because you just have enough cash and you don't have to worry about it very much. Somebody's taking care of it, and systems are in place that take care of your cash. And you, as an advisor, or you as a business owner, you don't have to worry about it. But you've got the predictive model that shows it. And it's not just short term, long term, what's happening. And when I say long term, minimum of 13 weeks, that's industry standard. It could go longer. I had a cash flow model that went out 5 years. Why? Because it was a construction company that had certain transactions. They had to wait for up to 5 years to close out the job and get some money back that they were owed. So we did it for 5 years. But most of the time, it's a much shorter period of time. And you want to look for peaks and valleys. What's a peak? It's when you've got a lot of cash. And what's a valley? When you don't have a lot of cash and possibly your bank account balance is going below zero. When that happens and you see these peaks and valleys, you want to move to step number 2, and that is learn to manage your cash. So when you have a peak, you're trying to reserve it and move it into the valley and spend it when you need it later on. Let me give you some examples. Well, and the last thing you want to do, let me tell you what you don't want to do. What you don't want to do is wake up on Monday morning and say, wow, we've got $250,000 in cash in the bank, and I want a new car. I want a new truck. I want to go on a super expensive vacation, which those are all good things. And maybe it makes sense because your cash flow model shows you that you're going to continually be growing and you've got reserves and everything else is in place. But all too often, what's going on? We're managing by bank account balance. And within a month or two, that $50,000 to $100,000 sports card, truck, whatever it is, and that used to be unusual, $50,000 to $100,000. Today, that's like almost entry price. That money is desperately needed to make payroll or to pay suppliers because there is a valley that you couldn't see. So you're trying to predict those and reserve that cash. Now, people say, David, what are the basics? So here's 2 basics. Every company should have a predictive cash flow model and a reserve account for savings. If possible, make that an interest-bearing reserve account. And if possible, make it for 3-4% interest, not 0.1% interest, which is all too common. If you want a recommendation where you can get for 3 or 4%, send me an email, david@davidsafir.com, and I'll give you a recommendation or 2. So managing money. When we manage money, there's basically 2 things you can do. 1, spend slower or bring money in faster. That's the basics when you're in trouble. Boy, if you've got enough cash, there's some really interesting strategies of spending faster and extending and letting people pay longer. But that's not what we're talking about. We're talking about the basics here today. And when you're managing, you're bringing expenses or pushing expenses out and bringing cash in faster, which is relatively easy. And I've got about, I think it's 100 to 150 strategies that are managed strategies, don't necessarily maximize. As a matter of fact, there's some pitfalls. Some of the managed strategies that improve cash flow, this is a hint, and this will be for a future show. I'll go into detail. You have to be careful because too many of the popular cash flow strategies are short-term cash flow increases. But just wait for 30 days and it'll be a negative. I'll give you one example and then we're going to move on to mentoring or a different topic about managing. So the one example I'll give you is how do you bring in your receivables? You want to get your money in faster to improve cash flow. Well, one of the strategies is always offer a discount for people to pay you faster. Okay, that's great. Somebody owes me $1,000, and if I give them a $50 discount for them to pay me this week instead of waiting for 2 or 3 weeks, that could be a huge relief this week because I've got some bills to pay. Got to make payroll, whatever it is. So I call up and I have to call 4 or 5 people because it's my, I get to control if I offer it, but it's my clients who are still making the decision to pay me faster or not. So I call and finally on that 5th client, they say, yep, I will pay you early and here's my credit card. Go ahead and charge it. Or they bring cash over to my office. Doesn't matter how. I got paid 2-3 weeks early. the $1,000 less 50. Okay, that's fine. Does it increase my cash flow? Yes, short term. What happens to the long-term cash flow? It goes down by $50. Now you say, well, that's not that much, David. Well, $50 is 5%. And if you have net profit of only 5%, you just lost all your net profit. If it's 10%, you just lost half of your net profit. It does have ramifications long term for your long term cash flow and profitability. So you have to be really careful when you're managing to understand short term, long term ramification. Who has controls and a whole bunch of other things. As a matter of fact, I've got an ebook, and well, let's see if I can put up a different banner right now. This is me getting fancy with my software. There you go. Here's an ebook. If you want, grab the ebook, go there, download it, and I will give you 24 strategies that are all positive strategies. No short-term negative, short-term positive, long-term negative. These are all positive strategies, and you control them. And if you read through it, and believe me, this is really good stuff, because I've purchased some books on cash flow, and I sit there and say, wow, my ebook that I'm giving away for free is so much more powerful and has better information than a book you can go buy for $10 or $15. Go download it. You'll see it's not only what the strategies are, but how to implement them, and you'll get an idea. Great. So let's move on from there. So we are managing cash flow. It's the same thing. Let me just talk for a minute about expenses. What you're looking for are the ones that are easy to change, first and foremost. And the big ones, it's not going to help you to delay a $20 payment. However, you look at the ones that there's built-in delays into your contracts or the way that your vendors do business. For example, if you have a mortgage on the building that you own that you're operating in, it could be built in that you get a grace period of 7 or 15 days. You can take it. It could help. And there's no negative ramification, no penalty. The same thing possibly with rent. That's usually tighter, 3 to 5 days. But also telephone bills, 30 days, no ramification. Utility bills, no ramifications. Think about the different bills that you pay that you might have to stack quite a few to really make a difference, but you can push out, and those companies that you're paying, it's built into their business model. They're not going to be calling you and hounding you. Who don't you want to pay late if you can avoid it? Small business owners like yourself. Small businesses depend on the cash flow, and it's a karma thing maybe, but that's just the way I think. The big companies can afford it. The small ones, not so much. Also be careful of penalties or anything that's going to trigger, like you don't want to pay a credit card late. That triggers going from free, you've got a free credit card, 0% interest, up to 30% overnight because you're a day late of whatever that trigger is. So that's on the expense side. I won't get into it a lot, but that's the moving money inside and out. And again, there's not dozens, there's 100+ strategies for managing your money. Well, what's next? Mentoring. Who gets the blame when there is no cash in the bank? It's generally the finance and accounting department. Well, let me tell you, that's not who's responsible for this. They might be able to coach, they might be able to identify, but accounting, forget about it. That's historical. It's backward looking. Accountants, bookkeepers aren't trained for the future. And it depends on the type of CFO you're working with or who you are, whether or not you're trained to deal with the future. I just told you, I worked with an operational CFO, brilliant person, and had gone on to do incredible things at a company that could deal with their brilliance. The one I worked with them at couldn't. But it's not the accounting department's fault. Where does it start? Well, business owners, it's partially where it starts, but also it starts with Sales. What are the margins? What are the terms? What are the conditions? When a client doesn't pay, it's not necessarily accounts receivables fault that it didn't work out. That it's not because they're not making phone calls, etc. It could be because whoever sold the goods and services, and that could be operations, it could be sales, didn't create an invoice accurately. And so you're stuck in negotiating exactly what needs to be paid. You need to be looking at different parts of the company and their operational impact on cash flow. And this is something, again, I could have entire episodes dedicated to the impact of sales on cash flow, the impact of operations on cash flow, HR, human resources. You name a department, and I can do a show on it for 15 minutes, half an hour, probably an hour. The point is, you need to be not digging down deep, spreading the wealth of knowledge and understanding and what you're trying to accomplish throughout the team, and help them help you as the financial professional or the business owner, that you are working together. They'll be able to see solutions that you might not be able to. As a matter of fact, this is one of the big reasons that people will come to Cash is Clear, is because I'm not an accountant. I've got lots of solutions. I understand accounting, but I go well beyond accounting and finance into all these areas of a company and how they impact the financial results, cash flow, and profitability. So, what's next? Now's the fun part. Maximize. You've got enough cash flow. You've got a little bit of extra. Who knows what? I've already given you one hint. You take your extra cash. This is a specific strategy. You don't just open up a bank account at the bank you're doing business with and get 0.1% interest. Open it up in a higher interest bearing account. If you want to, I'll tell you where my extra money goes. It goes into Fidelity, because they have a 4% account that's rock solid, that I don't have to worry about, that I get 4% day after day on cash reserves that are available to me within a day or two. So there you go. That's a strategy for somebody if you've got even a little bit of extra cash. But if, as you get more and more extra cash, there's strategies of whether it's paying down debt or it is doing some other things. And I'll tell you the creative one that I like. I've already told you that sometimes you want to spend money faster, not slower. It's counterintuitive. Most of the really big money makers when it comes to cash flow, profit and profit maximization are the opposite of what conventional wisdom is. So my favorite is that I will work with a vendor and say, we'll negotiate a rate. And I'll say, great, wonderful. I could pay you by credit card right now, or would you give me a discount if I paid with cash? Now, today, what is happening? Companies are setting cash prices and saying, if you want to use your credit card, it'll cost you another 3 to 4%. Well, if they don't offer, if they're just saying, yep, give me your card, ask them, if I give you cash, and it could be one of two ways: cut them a check, give them literal cash. Now, when I do it, it's literal cash. Not my problem what they do with that cash. Not my problem. If it's a big transaction, I have to report that I spent it in a certain way. If I go pull out more than $10,000 here in the United States from the bank, they're going to say, you got to fill out this form if it's $10,000, or if I do a bunch of them, that adds up. Let's not go there. So cash, and it works. And I've had 10 and 20% discounts off a negotiated price just by saying, what if I paid you cash right now? And sometimes it's not, I'll pay you cash right now. What if I paid you 50% cash now and 50% cash when you finish whatever we're negotiating? and it's accepted with a smile. I'm not saying you got to do this. It is just a, hey, by the way, I'd be willing to pay cash if you wanted to give me an additional discount. And every time that it's worked, it doesn't always work. It's not a, well, let me think. It's an immediate yes. That I'd much rather, there's no way I can make that much interest in the bank over the course of a month or two. When I'm saving 10%, it's amazing. So that's just one possibility to maximize cash flow, maximize profit. So paying faster, delaying payments, if you can afford it, let people pay over time. We've probably all done this at one point or another. Here is something for $100. If you pay it for today, or make, let me do the math, 4 easy payments of $28 each. So that's an extra $12. It costs 12% more when we do it like that. But if you're the person selling, you get 12% more. And it can be extremely profitable. Yes, you have to worry about credit. Yes, you have to make sure you have enough cash flow. But this is all part of the fun of maximizing. So we're almost done, and I promised you I would tell you the glue that holds everything together. And it's one word. But it's the most important word you're going to hear today. And this is not my opinion. I run masterminds, and at the end of the masterminds, I'll always say, what's the most important thing you learned today? Or tell me one thing you learned today. And it's not about the numbers. It's not about techniques, a particular strategy. 90% of the time, what I am told is the mindset. It's mindset. We talk about mindset during every single mastermind. And that is the glue that holds every stage together. It's overarching. You shouldn't even be starting to do a cash flow spreadsheet without realizing this is not accounting. It's about the cash, not accounting. I'm going to repeat that. Look at the cash, not accounting. It is completely different. And that's a fundamental mindset you have to start with. And it goes from there. I was talking to a client today about faith, about hope. When you're in cash flow problems, you've got to hold on to something, and it can really clarify. That's why I call it cash is clear. Because when you're working with cash, it illuminates and creates transparency. And it's a wonderful thing to behold. That's another mindset. I could talk about, well, and I've written articles. Go to my blog, davidsafir.com, look for the blog link, and just go start reading my blogs, and you'll see mindset after mindset. Here's another one I love. Fire your loser clients. Boy, people just rake me over the coals. Oh, my clients aren't losers. And it's like, guys, I'm not talking about they're bad people. I'm talking about you're losing money on your clients. Not all revenue is good revenue. If you've got clients that are costing you money, get rid of them. You'll instantaneously boost your bottom line. They go, but I'll lose sales. It's like, well, are you in business to make sales, or are you in business to make money? If you're in business to make money, then filter. Do yourself a favor. Figure it out which clients are losing you money. That is a key mindset. And it transitions perfectly to products. Kill your loser products or make them profitable. Either way works. Now, there's strategy behind this. There's all sorts of reasons you do things. And we'd have to talk about it. But I'm telling you right now that mindset makes the difference. And this is not taught in school. What we learn in school are hard skills, math, accounting rules, how to do a balance sheet, how to appropriately debit and credit, how to do calculations to figure out what your percentage cost of goods sold is. Those are hard skills. What I'm talking about are soft skills. And let me tell you, for myself and for the people that I work with, hard skills are easy. The easy skills, the soft skills are hard. People come to me and say, David, I want to learn how to do modeling. Great. I want to learn how to manage. Great. They understand the first two steps because that's what the popular knowledge is. And those are both hard skills, right? There's rules. This is how you add it up and subtract it. This is a strategy. You can implement it or you can't. The soft skills are mentoring because that actually involves working with people, and that's harder than working with numbers. Maximization to a point, that's soft and hard because there's a lot of negotiation involved. You have to figure out what's going to work, where you should go, and you've got so many opportunities. How do you narrow them down? So there's soft skills involved also. But mindset is a soft skill that is extremely hard to dominate. A year in, got somebody in the mastermind. We were looking at a P&L, and automatically he starts talking about taxes. And I'm like, so time out. Oh, hold on. What are we talking about today? And he just laughed, and we always get a good laugh out of this. He's like, oh yeah, we're talking about cash. So that is the mindset you can walk away from here today with, is that soft skills are hard. It's the hard skills that are easy. Listen, it's been a joy being here. Went a little bit over time. Hopefully, well, if you're hearing this, you're still with me. So thank you. If you're interested in learning a little bit more, get in touch with me, david@davidsphere.com, or go to my website and you can send me a note there. If you are a company in trouble, just say, David, it's urgent for me to talk to you. If you're an advisor who has a company you're working with that's in trouble, say, David, it is urgent that I talk to you. I sort of clear the decks and make sure I have an initial conversation within 24 hours when there's urgency like that. Remember, cash creates financial clarity and confidence.